Welcome to the deep dive. Okay, so you sent over this massive Q3 2025 filing pack, the 10Q for Duke Energy and, well, all 8 of its utility registrants. We've waded through it, and our mission today is really to cut through the dense jargon and the sheer volume of numbers, because this isn't just some dry accounting exercise, right? It's more like a roadmap. We're looking for the strategy shifts, these huge multi-billion-dollar investment plans, the high-stakes rate fights, and honestly, the staggering long-term debts they're managing.
Absolutely. That tension you mentioned, that's really the core of it. Before we jump into the details, though, it's probably good to just map out who we're talking about. When we say the Duke Energy registrants, it's Duke Energy Corp itself, plus Duke Energy Carolinas, Progress Energy, Duke Energy Progress, Duke Energy Florida, Ohio, Indiana, and Piedmont Natural Gas. It's a big footprint. And structurally, it really boils down to 2 main parts. You've got the electric utilities and infrastructure, the EU&I. That's the big power generation and delivery side across the Carolinas, Florida, the Midwest. Then there's gas utilities and infrastructure, G&I. That's mostly Piedmont Natural Gas Handling Distribution. So, yeah, we're covering the whole regulated system. And everything gets filtered through regulators.
Right. And what jumped out immediately from this Q3 report was this very active reshaping of the portfolio. They're not just sitting still. Take the divestitures. They decided back in 2023 to sell off pretty much all the commercial renewables assets. That deal brought in $1.1 billion upfront. But the key thing here is that the final chunk, that $551 million, just landed this past April 2025. So that cash is now on the books, ready to be deployed back into the core regulated side.
Exactly. And that streamlining is happening on the gas side, too. Piedmont Natural Gas agreed to sell its Tennessee operations to Spire Inc. That agreement was inked in July 2025. And we know the Hart-Scott-Rodino waiting period, that's the antitrust review, it expired in September. So that deal's definitely moving ahead.
And you can see the ripple effect on the financials right away. Because that sale is basically locked in, reclassified $294 million in goodwill tied to Tennessee. It shifted straight into assets held for sale just in Q3. Shows how fast strategy hits the balance sheet.
So selling assets is one part, but bringing in partners, that's the other side, and maybe the biggest headline in these filings. We're talking about the deal involving Duke Energy Florida, or DEF. The partner is Peninsula Power Holdings LP. That's a Brookfield entity. And this isn't just, selling off a piece. It's a huge capital injection into a core regulated business. The first payment alone, the first closing purchase price, is $2.8 billion.
Okay, $2.8 billion. Let's unpack that. Why sell almost 20%? Because the cap is 19.7% ownership for the investor, right? Why sell that much of a stable asset like DEF?
Well, that's the interesting part of the structure. They raise a massive amount of capital, that $2.8 billion, without losing control. DEF stays a regulated utility under the Florida Commission and FERC.
Right.
And given the absolutely huge sums needed for grid upgrades for the energy transition, this kind of deal lets them tap into infrastructure funds like Brookfield. These funds want stable, long-term returns, which regulated utilities offer. So Duke gets capital, de-risks its balance sheet a bit, and the investor gets a solid asset. It shows the regulated model is still very attractive.
That's a really key strategic point. And it leads right into those complexities you mentioned, the high-stakes regulatory decisions, because Duke can plan all day long. But everything from raising capital like that DEF deal to just recovering costs after a storm, it all comes down to getting the nod from regulators, NCUC in North Carolina, PSCSC in South Carolina, IURC in Indiana, KPSC in Kentucky, FERC at the federal level.
Absolutely. The filings paint a picture of recent wins and, compromises in rate cases. Take Duke Energy Progress in South Carolina. They filed back in June 2025 asking for a 12.1% bump, about $75 million, and they wanted a 10.85% return on equity, or ROE.
Which sounds ambitious.
It often is. That's the starting point. But by October, they hammered out a settlement. The final increase was lower, a net $40 million, and the ROE got knocked down to 9.99%.
That dropped from 10.85% to 9.99%. It sounds small, but across billions in assets.
Exactly. It translates to significant money left on the table, so to speak. It's a concession.
And sometimes they even have to give money back. Look at Duke Energy Kentucky. They put a $70 million rate hike into effect in July 2025. But, and this is the crucial part, it was subject to refund.
Which is exactly what played out. The Kentucky Public Service Commission, the KPSC, made its final call in October. They only approved $44 million of the $70 million asked for.
So...
Since Duke Kentucky had been collecting at the higher rate for a few months, the KPSC ordered them to refund $7 million to customers for that difference collected since July 3rd.
Wow, $7 million in refunds. That's not trivial. How do they even manage that risk? Do they have to, hold that extra cash aside just in case?
They do, essentially, through accounting reserves.
Mhm.
They estimate, but they always know a refund is possible. It forces a certain conservatism, making sure they don't spend based on revenue that isn't fully approved yet. It's a built-in risk of the regulatory process.
Okay. And beyond the planned rate stuff, there's the weather. Huge cost there. The Q3 filings really underscore the impact of that brutal 2024 storm season. Hurricanes Debbie, Helene, and Milton.
Yeah, a historic season.
Duke Energy Florida got approval back in February 2025 to recover about $1.1 billion in storm costs, and get this, over just 12 months. That's a fast recovery timeline for such a big number.
It is. And that brings us to the how. How do you handle $1.1 billion in sudden costs? The filings talk about storm recovery bonds. It's a type of securitization.
Securitization.
Meaning they package up the right to collect that future storm recovery revenue from customers and sell bonds backed by it. Duke Energy Carolinas and Duke Energy Progress both did this in September 2025. They used the bond proceeds to pay off short-term loans they'd taken out right after the storms, $700 million for DEC, $250 million for DP.
Okay, so it turns unpredictable, massive storm costs into predictable long-term debt with hopefully lower interest rates.
Exactly. It smooths things out for the utilities' finances, and it spreads the cost recovery for customers over many years, avoiding a huge immediate rate shock. It's a standard tool now for these massive weather events.
Right. So while they're managing today's costs and trimming assets, the really big story seems to be locking things in for decades. Let's shift to that long-term investment piece, Section 3.
Yeah, we're seeing huge generation commitments needing serious regulatory approval. Just in October 2025, they got the green light, the CPCNs, Certificates of Public Convenience and Necessity, for two big natural gas projects. One's a second combined cycle unit in Person County for Duke Energy Progress, and the other is the Cayuga combined cycle project for Duke Energy Indiana.
Why are the CPCNs such a big deal?
Think of it as the ultimate permission slip from the regulator. The CPCN says, yes, this multi-million-dollar plant is necessary for reliable power, and crucially, yes, you'll be allowed to recover the cost from ratepayers over time.
So it takes a lot of the investment risk off the table.
Pretty much. Once you have that CPCN, you know you can build it and eventually get paid back through rates.
And this is where the time horizons get kind of mind-boggling. We're talking 50, 60, even 80 years locked in. Look at Oconee Nuclear. The NRC, the Federal Nuclear Regulatory Commission, gave them that subsequent license renewal back in March 2025. That keeps Oconee running through 2054.
80 years of operation. I mean, just think about the scale of that decision. Extending an existing, largely paid-for carbon-free asset out that far gives them enormous baseline stability.
Yeah.
And they're trying to do it again with the Robinson Nuclear Plant. Filed that application in April 2025, hoping for an extension to 2050. We should see a decision on that next April.
And it's not just nuclear power. They filed with FERC, the Federal Energy Regulator, in July 2025 to get a 50-year license extension for the Bad Creek Hydro Plant. That could keep it running until 2077.
Right, so this whole suite of extensions shows a real strategy. Maximize the life of the existing big, reliable, often zero-carbon generators.
And it's a big but. These super long-lived assets come with massive long-term cleanup costs attached. Which brings us to the asset retirement obligations, the AROs. This number is just huge.
It really is.
Yeah.
As of September 30, 2025, the total AROs across all the Duke Energy registrants stood at $9.644 billion.
Almost $10 billion.
Yeah. I mean, remember that $1.1 billion storm cost we talked about? That's dwarfed by this. These are legally required future spending commitments for cleanup and decommissioning.
And what's inside that $9.6 billion? The filings break it down. It's basically two giant pieces, roughly equal. $4.625 billion is set aside for eventually decommissioning all their nuclear plants. And $4.688 billion, even slightly more, it's for closing coal ash ponds and landfills. Almost $4.7 billion just for the coal legacy.
That coal ash number is critical. It's been a huge focus for regulators and environmental groups for years now.
So is $9.6 billion the final number? Or is there a risk, especially with something complex like coal ash cleanup, that the actual cost could end up being way higher? That must create tension with regulators.
That is the multi-billion-dollar question. The estimate is based on current plans and regulations, but those can change. And litigation is a constant factor. We see that right now with the Mooresville coal ash class action suit. Filed late 2024, amended this past July. It claims contamination, lower property values.
And there's a hearing scheduled soon.
December 15, 2025. So yeah, this massive long-term liability is also a very immediate, very real legal headache they have to manage today. It constantly pressures that estimate.
And it's not just coal ash or nuclear. There are other long-term things, like asbestos. Duke Energy Carolinas has $404 million specifically reserved for asbestos claims expected through 2045.
Right, but what's key there, as the filing notes, is they also have $557 million booked as insurance recovery receivables.
Meaning they expect insurance to cover more than the reserved amount?
Essentially, yes. They expect insurers to cover the projected claims, which significantly mitigates the direct financial hit to Duke itself for that specific issue. Shows the importance of insurance for these legacy liabilities.
Okay, so connecting all these pieces, the company clearly sees managing these huge liabilities, especially the AROs, as tied directly to managing regulatory risk, right?
Absolutely. The filings spell out the key risks pretty clearly. Number one is probably the uncertainty around future environmental rules, especially climate change regulations, and the costs that come with them. And tied right into that is the risk of not being able to recover those costs quickly enough from customers. If regulators delay approving recovery for coal ash cleanup or for costs related to reducing carbon emissions, that directly impacts the utility's bottom line. That's the tension between the $9.6 billion ARO and needing that stable ROE.
Makes sense. They also call out the usual economic headwinds, risk of big industrial customers leaving or just people using less power due to inflation, tariffs, high fuel costs, things that erode the revenue base.
True. But maybe the most forward-looking risk they list is about technology disruption. They specifically mention state and federal policies pushing distributed generation, things like rooftop solar, home batteries. They acknowledge this could lead to stranded costs. That's utility jargon for having paid for big power plants or grid components that aren't fully needed anymore because customers are generating their own power. That's a major long-term challenge for the traditional utility model.
And they even mention advancements in technology, including AI, as a potential risk factor to watch.
Right. The landscape is constantly shifting.
Okay, and just quickly on financial health, they seem prepared for these big plans. Liquidity looks okay.
Yeah, the numbers look solid for now. They reported $688 million in cash on hand at the end of Q3. Plus, they have $7.5 billion available under their main credit line, their master credit facility. And they actually expanded that facility's total capacity to $10 billion back in March 2025. So yes, they appear to have the financial firepower, the dry powder, to fund these multi-decade projects and manage near-term needs.
Okay, so let's try to pull this all together. From this deep dive into the Q3 filings, we've seen Duke Energy actively trimming its portfolio, selling off commercial renewables, the Tennessee gas unit. At the same time, they're bringing in significant outside money, like that $2.8 billion Brookfield deal for Duke Energy Florida. They're navigating the rate case maze, sometimes settling, sometimes giving refunds, like in Kentucky. And they scored major wins, extending the life of crucial assets like Oconee out for decades. But underpinning everything is the sheer scale of these long-term commitments, especially those massive asset retirement obligations.
Right. So what's the final thought here? I mean, those store and recovery numbers were huge, right? $1.1 billion for Florida alone. And the financing, the storm bonds, it's complex stuff. But at the end of the day, those are sort of tactical responses to immediate events. The truly strategic number defining Duke's future for decades isn't the storm cost. It's that nearly $10 billion in AROs. Specifically, that $4.7 billion for coal ash cleanup. The ongoing process of estimating those costs, fighting about them in court, and convincing regulators to let them recover the money from customers. That is what will shape the financial health, the regulatory battles for Duke, and frankly, for many big utilities for literally generations to come. It puts even billion-dollar storm seasons into perspective. These environmental legacy costs are on a whole different timescale and magnitude. Something for you, the listener, to really think about the multi-generational shadow these commitments cast.